Hello and welcome to the DIY Investing YouTube channel. We're working through every company in the S&P 500, and today is Lumen Technologies, ticker LUMN. This company was renamed from CenturyLink, which is why it's in the C's of my work through. Now, over the next few minutes, I'll discuss both my thoughts on the valuation of this company and its business quality. First up, we look at market cap. Market cap is $11 billion and EV is $39 billion. This suggests about $28 billion in debt leverage on this business, which is absolutely humongous because the debt is over twice as large as the current equity market cap. This means we're basically a highly leveraged company here. This is in the diversified telecommunication services industry. Let's see what they do. They have Quantum Fiber and CenturyLink brands, providing business and residential customers. They have two segments, business and mass markets. They have cloud services, IT solutions, communication, VPN, datanet, Ethernet, IP, and voice over internet protocol. They also provide fiber infrastructure services, voice services. Okay, so that gives us a little bit of information. It's a very high turnover, but that's not surprising for the S&P 500. Now, let's look at some of our key statistics and return on invested capital. Now, one of the things I look for is how many years are you profitable out of the last 20, and it looks like they have lost money in 4 years, 2013, 2018, 2019, and 2020. 4 years of losses in the last 20 is a little too high for my taste, so it's not a company that necessarily I will invest in, but it does give us some indication that they do have some cyclicality in their business. Although the fact that this is 3 years in a row in losses during what was not a recession in 2018 and 2019 is a little concerning. So I'm concerned about what's going on here in the recent years. You also looked at returns were better in the early 2000s and then have gotten worse in the 2010s. And so there's some concern that this business is deteriorating over time. Next, even in the years of profitability, you're not earning a lot of money. Your peak is at 13% in 2002, but you've not seen that since 2003. You're basically at 5% in the early 2000s. You get up to 6%, 5% to 2010. But in 2011, you go down to 1%, 1%, loss of money, 2%, 2%, 1%, 2%, and then you're at 4% in 2021. Overall, you're running about a 2 to 4% return on invested capital, which is absolutely terrible if you want a good return on your investment as an investor. And you see this when you look at these 10-year median returns. They're turning a 2% return on invested capital and only to a 4% return on equity. What this means is that if you buy and hold this business and you're expecting more than a 4% return, you're kind of crazy. You're not going to get a long-term return on your investment higher than the return on equity of the business itself. So if you own the equity and you're expecting more than 4.2%, then it's not the investment for you. And if you're considering buying this company, you need to be aware that your returns are basically capped at this return on equity unless they can turn the business around. And I don't see any evidence in these numbers so far that that's likely. What this means is that a PE of 5.2 is actually still expensive for a business like this if they refuse to grow or if they grow at all, because any growth is destroying capital and they need to return all their money to shareholders. Now, if they're issuing a 20% dividend every year because you have this low PE and all that money is being given to shareholders, then maybe that's okay. But I have my doubts that that's what we're going to see here, because one of the things you see is you do have a dividend and their dividend has been going down over time. It was $2.90 in 2012. It's down to $1 in 2021. I have a feeling that they can't even pay a dividend without raising debt, because they aren't able to even cover the interest rate based upon these returns. But we'll see more if we dive on to the rest of the numbers. If you're enjoying this video so far, please hit that like button and subscribe so you can get more information as I go through each and every company in the S&P 500 as I create YouTube videos that help you to learn about investing and become a better investor. So please subscribe, please hit that like button. Let's keep going. Now, these revenue growths are pretty low, but you do have some positive EPS growth, so I'm curious how that came about. Let's look at the income statement. Okay, so income statement, we can see positive gross profit every year. That's a good sign. Positive operating profit every year. That's a good sign. But you do have some losses. You have some non-operating income losses here for 3 years in a row. So that makes 2018 through 2020 look a little less bad. Same thing with non-operating income creating those big drops in 2013. However, you have to wonder what this is. If this is big write-offs, those write-offs matter. They play into it for sure. And what's actually amazing is these huge losses come into play and cause a massive dilution of equity. In a single year, you go from 628 million shares outstanding to 1 billion shares outstanding. You have about a 50%, no, like an 80% increase in the shares outstanding due to these massive losses. So this is actually a huge concern. I wonder if there's an acquisition that was done in here. Let's look at cash flow. There's a big acquisition in 2017 that they basically could not afford with the money that they had on hand. And so this is just a complete waste of their money in terms of destroying value for shareholders. You're paying out huge dividends each and every year, but you have no cash flow to do it because you're having to issue debt. So you have all this cash flow from operations and it's being heavily reinvested. Actually, this is really weird. So you have cash flow from operations of 6 million or 6 billion, 4 billion. And this cash flow from operations consistently exceeds your cash flow from investing by, 2 to 3 billion a year, maybe. So it looks like you should be able to cover your dividends, which is really surprising. So let's go to that income statement because you've got to you're dumping this all on income, your interest income. So what is going on with your cash flow? So your cash flow situation is really weird because you have all this investment that's going on, and yet instead of being able to buy back shares, they're paying out huge dividends, and looks like they're trying to pay down debt, but then they're having to issue new debt. They're trying to pay down debt. Is their debt going down over time? So it looks like their debt goes down a little bit, then it goes up again, goes down a little bit, down, and then up a massive amount. And now they've been paying down debt for a few years. So that's where they're spending their cash flow. They are spending cash flow to pay down debt. So they do have some positive free cash flow here, and they are paying some dividends from that as well. But you have these massive new financings every year. You're having to continuously refinance in order to maintain this, what looks like a pretty sinking ship. So it's a little confusing because you have a big acquisition here. You have big write-offs. I'm wondering if they wrote off that acquisition then in the next few years. 2018, 2019, 2020. So you're basically just seeing massive destruction of value. When you have your net income triple, you're going from 777 million to 2.1 billion. You tripled your net income over the decade, but you less than doubled your EPS. Is actually quite bad, and it's all because you can increase the share count by 80%, and that just really destroys the potential value for this business. I have to question the capital allocation decisions of this management because they just basically made a massive acquisition that immediately destroyed value based upon the numbers I'm seeing here. And so it would be a major concern for me. Even if they hadn't done that, though, you're still talking only 2 or 3% returns on invested capital. Now, they are returning a lot of cash to shareholders, which is what you'd want to see. You really need that. But what you can clearly see on this income statement, too, is you're going to have big... Maybe it's not on the income statement. Are they going to have it on depreciation? Yeah, you have really large depreciation numbers, which is bringing down your net income. So those depreciation are having to be replaced with new equipment, and so that's why you have this huge cash flow from operations much higher than net income. So you do have this large cash flow, which is helpful. But because they have to reinvest it and they can't pay it all out to shareholders, you're not seeing that return that you would like to see. So for me, I would avoid Lumen Technologies. It's not attractive. It looks like a very poor business from your return on invested capital. And some of the capital allocation decisions are very questionable to me. So if you enjoyed this video, please hit that like button. Don't forget to subscribe. Your subscriptions and your likes help me to grow the channel, help me to spread with the Yugo algorithm to more people. Also, feel free to let your friends know about the channel. I would really appreciate that. Thank you for listening, and until next time, stop paying fees, start building wealth.